In Chapter 1 of the Little Book of Common Sense Investing by John Bogle, a parable illustrates the folly of overcomplicating investments. The story features the Gottschalk family, who originally own all U.S. stock, reaping full investment rewards. However, when they start trading stocks among themselves, influenced by various helpers like brokers and consultants, their overall wealth grows more slowly. These helpers charge fees, leading to reduced family earnings and increased taxes. As the family employs more helpers, including stock-picking experts and financial consultants, their share of investment returns diminishes further due to additional costs and taxes. Ultimately, the wisest family member advises returning to their original simple strategy of holding all stocks passively, thus avoiding unnecessary costs and maximizing returns. This tale underscores Bogle's advocacy for index funds, emphasizing low costs and long-term holding as keys to successful investing. The chapter concludes with external endorsements of index funds, highlighting their effectiveness in outperforming actively managed funds due to lower costs and taxes. Chapter 2 of the book, Rational Exuberance, focuses on the correlation between shareholder gains and business performance, emphasizing Warren Buffett's philosophy that long-term shareholder gains must inevitably align with the actual business gains of the company. The chapter explains how stock market performance is often swayed by investor emotions, causing temporary disparities between stock prices and the intrinsic value of businesses. The author discusses the concept of speculative return, which can either add to or detract from the investment return, and how this return is influenced by the changing price-earnings ratios driven by investor sentiment. The historical analysis shows that over the long term, the total return on stocks closely mirrors the actual investment return, underscoring that in the long run, market speculation has minimal impact on returns. The author advocates for a focus on long-term business performance over short-term market fluctuations, citing the consistent long-term growth of investment returns. The chapter concludes by highlighting the importance of understanding the distinction between the real market, focused on actual business performance, and the expectations market, influenced by speculation and investor emotions, advising investors to concentrate on the former for long-term success. Chapter 3 of the book advocates for the simplicity and effectiveness of investing in a broad, diversified portfolio of U.S. stocks and holding on to it indefinitely. This approach is based on the principle of Occam's razor, suggesting that the simplest solution is often the best. The chapter highlights the S&P 500 index and the total stock market index as key examples of such investment strategies. While the S&P 500 includes the 500 largest U.S. corporations, the total stock market index is more comprehensive, encompassing around 3,599 stocks, including those in the S&P 500. The chapter underscores the similarity in performance between the S&P 500 and the total stock market index over long periods, with both showing closely aligned returns. It argues that investing in a low-cost, all-market fund is a winning strategy over time, as it is guaranteed to outperform the average returns of equity investors. This is because the total market's gross returns, minus the costs of financial intermediation, equal the net return to all investors. The author also critiques actively managed mutual funds, revealing that a significant majority underperform their benchmark indexes over extended periods. This underperformance is shown across various fund categories, reinforcing the argument for the superiority of index funds. The chapter concludes by reinforcing the value of simplicity in investment strategies, in line with Occam's razor, and cautions investors against expecting high returns in the future based on past performance. Chapter 4 explains how investors often earn less than market returns due to various investment costs like management fees, brokerage commissions, and other expenses. These costs turn investing from a potential winner's game into a loser's game after expenses. The author highlights that beating the market is impossible on a net basis due to these costs. With examples, the chapter shows how long-term returns are significantly reduced by these expenses. It advocates for low-cost index funds as a more efficient investment strategy, noting that high costs in actively managed funds often lead to underperformance. The chapter concludes by emphasizing the importance of understanding and minimizing investment costs, with endorsements from industry experts supporting the effectiveness of index funds. Chapter 5 of the book emphasizes the importance of focusing on low-cost funds for successful investing. It argues that while past performance of funds is unpredictable and inconsistent, the cost of owning mutual funds is a persistent factor affecting returns. The chapter highlights three main costs: the fund's expense ratio, sales charges on share purchases, and the costs associated with portfolio turnover. These costs, often overlooked, have a significant and enduring impact on fund performance. Higher costs are consistently linked to lower returns across various fund types and investment styles. The chapter presents data showing that funds with lower costs not only yield higher net returns, but also carry lower risk. This inverse relationship between costs and returns is further supported by an analysis of equity mutual funds over a 25-year period, demonstrating that low-cost funds significantly outperform high-cost ones when returns are compounded over time. The chapter also underscores the advantages of index funds, which typically have the lowest costs and deliver competitive returns with lower risk. It concludes by reinforcing the idea that minimizing investment costs is crucial for maximizing returns, advocating for the selection of low-cost funds, especially index funds, as a core investment strategy. Chapter 6 highlights the significant role of dividends in stock market returns, noting their substantial contribution since 1926. The power of compounding is evident, with a $10,000 investment in 1926 growing to $59 million by 2017 with reinvested dividends, versus $1.7 million without them. Despite their importance, actively managed mutual funds often neglect dividend income, with their fees consuming a large portion of it. For example, in 2016, actively managed growth funds absorbed all dividend income, while value funds lost 58% to expenses. In contrast, low-cost index funds had minimal impact on dividends, with expenses taking only 2 to 4%. The chapter argues for the benefits of low-cost index funds and supports John Bogle's philosophy of focusing on dividends, maintaining low costs, and simplifying investments. Chapter 7 of the book, The Grand Illusion, reveals a significant disparity between the returns reported by mutual funds and the actual returns earned by mutual fund investors. Despite average mutual funds earning a return of 7.8% per year over the past 25 years, the average fund investor only saw returns of 6.3% due to the impact of capital flows, a figure substantially lower than the S&P 500's return of 9.1%. The chapter emphasizes that investor behavior and fund selection play crucial roles in this gap. Many investors tend to enter the market at high points and choose poorly performing funds, influenced by optimism, greed, and aggressive marketing from fund companies. This behavior, coupled with the high costs of mutual funds, results in significantly lower real returns for investors, especially when compared to those who invest in low-cost index funds. The chapter argues for the superiority of index funds, which avoid these pitfalls by offering lower costs and reducing the influence of emotional investment decisions. Notably, financial experts like Warren Buffett and Charles Schwab advocate for the simplicity and effectiveness of index fund investing, emphasizing the importance of minimizing expenses and emotional decisions in investment strategy. Chapter 8 of the book emphasizes the often overlooked impact of taxes on investment returns, particularly in the context of mutual funds. The author points out that high portfolio turnover in actively managed funds, averaging 78% per year, leads to significant tax inefficiencies. This is contrasted with the strategy of index funds, which typically have much lower turnover rates. The chapter reveals that the high turnover in active funds results in higher taxable events, subsequently reducing net returns for investors. For example, the author notes that while the average equity fund returned 7.8% annually, taxes reduced this to 6.6%. Conversely, index funds, with their lower turnover and associated tax burdens, provided higher after-tax returns. The author also highlights the tax inefficiency of active funds due to their frequent trading, leading to more frequent capital gains taxes, often at higher rates. In contrast, index funds tend to be more tax efficient, although they can be less efficient in distributing dividend income due to their lower costs. The chapter concludes by underscoring the critical impact of taxes on investment returns, placing it alongside high costs, investor behavior, and inflation as major factors that significantly reduce the net gains of equity fund investors. Chapter 9 of the book addresses the concept of planning for lower future returns in stock and bond markets. The author reflects on the exceptional returns experienced since Vanguard's founding in 1974, emphasizing that these were partly driven by speculative returns, notably the increase in the price-earnings multiple. This phenomenon, not likely to be repeated, suggests future stock market returns may be subdued. The author projects cautious future returns, with a possible annual investment return of 6% for stocks, and speculates on a decrease in speculative returns. This chapter stresses that past extraordinary returns were influenced by factors unlikely to persist, leading to the expectation of lower future returns. For bonds, the current interest yield is a key indicator of future returns, with a 3.1% annual return expected over the next decade. The chapter concludes by examining the impact of investment costs and inflation, especially for actively managed funds, and suggests that low-cost index funds are a more favorable option. The author's projections are supported by various financial experts and are grounded in the reality of current economic indicators. Chapter 10 of the book discusses the challenge of selecting long-term winning mutual funds. It highlights the common investor misconception that they can easily choose funds that will outperform. The chapter reveals that out of the 355 equity funds that existed in 1970, about 80% went out of business, and only a tiny fraction consistently outperformed the market. The chapter illustrates this point with the histories of the Fidelity Magellan and Contra Fund, which, despite their initial success, faced difficulties maintaining their performance over time. It underscores the unpredictability and transient nature of mutual fund performance, emphasizing that past success is not a reliable indicator of future results. The chapter advises against trying to find the few exceptional funds and instead suggests investing in a low-cost index fund that covers the entire market. This approach is more likely to yield consistent returns without the risks and challenges of actively managed funds. The chapter concludes with a reminder that even renowned investors and experts like Warren Buffett advocate for index funds over trying to pick individual winners in the mutual fund market. Chapter 11 of the book discusses the concept of reversion to the mean in mutual fund investments. It emphasizes that investors often mistakenly base their decisions on short-term performance, heavily influenced by the star ratings from services like Morningstar. These ratings predominantly reflect recent performances, which can be misleading. Studies cited in the chapter reveal that a significant majority of top-performing funds fail to maintain their high ratings over time. The data shows that mutual fund performance is subject to reversion to the mean, meaning that funds which perform exceptionally well or poorly in one period often see their performances regress to the industry average in subsequent periods. This pattern is consistent across different timeframes and suggests that fund performance is largely random and not necessarily indicative of managerial skill. The chapter concludes by cautioning investors against choosing funds based solely on past performance and promotes the use of index funds as a more reliable alternative. It underlines the difficulty in distinguishing between a fund manager's skill and luck and how, over time, even seemingly successful funds might just be beneficiaries of chance rather than skillful management. Chapter 12 of the book addresses the challenges and pitfalls of selecting equity funds for long-term investment. The author highlights the difficulty in choosing winning funds based on past short-term performances, often leading to disappointment rather than success. The chapter suggests considering professional financial advice but remains skeptical about advisors' ability to consistently select funds that outperform the market. While acknowledging that some advisors can offer valuable services like asset allocation, tax advice, and financial planning, the author is critical of their ability in fund selection. Evidence is presented showing that the average returns from funds selected by advisors are not significantly better than those achieved by the market average. The chapter also discusses the negative impact of broker-managed funds, with examples like the Merrill Lynch debacle illustrating the risks of relying on stockbrokers for investment decisions. Despite these criticisms, the author recognizes the value of RIAs in offering peace of mind and handling complex financial decisions, albeit with a caution about their ability to beat the market. The chapter concludes by discussing the rise of robo-advisors as a low-cost alternative and the importance of the fiduciary standard in ensuring advisors prioritize clients' interests. Overall, the chapter advises caution and diligence when selecting professional financial advice, emphasizing the simplicity and effectiveness of low-cost index funds. Chapter 13 advocates for the advantages of investing in traditional low-cost index funds that track the stock market, emphasizing the importance of minimizing costs. The chapter revisits key lessons from earlier chapters, highlighting the ineffectiveness of selecting equity funds based on past performance and the mean reversion of fund returns. It introduces the Monte Carlo simulation, demonstrating that over longer periods, the likelihood of actively managed funds outperforming index funds decreases significantly. The author argues for the simplicity and efficiency of index funds, cautioning that not all index funds are created equal, with substantial differences in costs impacting long-term returns. The chapter underscores the effectiveness of index funds across various market segments and warns against the pitfalls of emotional investment in sector-specific funds. It concludes by reinforcing the critical role of simple arithmetic in investment, promoting low-cost index funds as a superior strategy for long-term investment success. Chapter 14 focuses on the principles of humble arithmetic applied to bond funds, highlighting that bond market returns are largely driven by interest rates beyond the control of fund managers. It argues for bonds in an investment portfolio due to their historical performance, especially in reducing portfolio volatility and offering yield advantages over stocks. The chapter critiques actively managed bond funds for generally underperforming their benchmarks, largely due to higher costs. It advocates for bond index funds, which benefit from broad diversification, low costs, and disciplined strategies, similar to stock index funds. The effectiveness and growing popularity of bond index funds are supported by financial experts, emphasizing their long-term advantages, simplicity, and cost efficiency. Chapter 15 examines the rise of exchange-traded funds, referred as ETF, and contrasts them with traditional index funds, referred as TIF. ETFs, while similar in structure to TIFs, are often used for short-term trading rather than long-term investing, leading to higher costs, brokerage commissions, and tax burdens. The chapter highlights the first U.S. ETF, the SPDR, and its role in popularizing ETFs. Despite their growth and popularity, the author criticizes ETFs for straying from the principles of diversification, low cost, and long-term investment inherent in TIFs. The chapter warns investors about the risks of high turnover rates, emotional trading, and chasing past returns in ETFs, suggesting that these practices can erode investment returns. The author concludes by advocating for the traditional index investing approach and cautions against the speculative nature of most ETFs. Chapter 16 of the book discusses the evolution and competition within index funds, particularly focusing on the rise of exchange-traded funds, referred as ETF, that promise to beat the market. Traditional index funds, referred as TIF, like the S&P 500 index fund, have been immensely successful since their inception in 1975, amassing trillions in assets. This success has led to fierce competition among fund managers who have reduced costs to attract investors. A new trend in indexing involves ETFs offering smart beta strategies which claim to outperform broad market indexes by focusing on specific factors like value, momentum, or dividends. The author, however, expresses skepticism about these strategies, noting the difficulty of consistently beating the market and the tendency for today's winning factors to become tomorrow's losers. Historical examples like the Go-Go funds and Nifty 50 are cited as cautionary tales of market fads that ultimately did not benefit investors. Despite the popularity of smart beta ETFs, the author urges investors to remain skeptical of these new strategies and stick to traditional index funds, which have a more proven track record and offer a fair share of market returns with less risk. The chapter concludes with endorsements of traditional indexing from notable economists and financial experts, reinforcing the author's perspective. Chapter 17 of the book discusses Benjamin Graham's views on investing, particularly the concept of indexing, as interpreted and confirmed by Warren Buffett. Graham, the author of The Intelligent Investor and a proponent of value investing, emphasized the need for defensive investing for the majority who lack the time and expertise for aggressive stock selection. He advocated for a diversified portfolio offering reasonable returns with minimal risk. The chapter traces the evolution of mutual funds, highlighting Graham's realistic assessment of their performance and his skepticism about their ability to consistently outperform the market. Graham, later in life, recognized the challenges in finding undervalued securities and shifted his advocacy towards simpler investment strategies like index funds, which align with his principles of diversification and rational expectations. He doubted the ability of professional managers to outperform market indices consistently, given the costs and speculative behaviors involved. Warren Buffett, a disciple of Graham, confirms Graham's endorsement of low-cost index funds as sensible investments for most people. Buffett's affirmation underscores the value of Graham's investment philosophy, which prioritizes long-term, cost-effective, and diversified investing strategies for achieving satisfactory returns. Chapter 18 focuses on asset allocation in investing, specifically the balance between stocks and bonds. The chapter highlights the significant role of asset allocation in determining investment returns, with studies showing it accounts for 94% of portfolio performance differences. It revisits Benjamin Graham's 50-50 stock-bond allocation guideline, noting its relevance despite changing market yields over time. The author emphasizes considering an investor's ability and willingness to take risks when deciding on asset allocation. For asset accumulators, a more aggressive stock allocation is suggested, while a conservative approach is recommended for retirees. The chapter also discusses the impact of fund costs on returns, showing that lower-cost portfolios can outperform higher-cost, higher-risk ones. The author acknowledges the uncertainty and personal judgment involved in asset allocation, sharing his own approach as an example. The chapter concludes by underscoring the complexity of asset allocation and the need for thoughtful decision-making. Chapter 19 focuses on the merits of simple asset allocation in retirement investing, emphasizing a balanced index fund with a 60-40 stock-bond split. This fund, introduced in the author's 1993 book, has outperformed peers due to its low costs and resilience during market downturns, making it suitable for various investor profiles. The chapter also revisits Benjamin Graham's asset allocation advice, advocating flexibility based on age and circumstances. It highlights the growing popularity of target date and life strategy funds, tailored to different investment goals. Additionally, the chapter underscores the importance of considering Social Security in retirement planning and discusses the need for capital drawdown due to low yields on stocks and bonds. The author recommends a flexible approach to retirement spending and concludes by endorsing the simple, efficient Bogle model, which has proven successful against more complex investment strategies. Chapter 20 advocates for the enduring strategy of investing in low-cost index funds, specifically in an S&P 500 or total stock market index fund for equities, and a total bond market index fund for bonds. Highlighting Warren Buffett's support for this approach, the author emphasizes the importance of starting investments early, acknowledging risks, diversifying to eliminate specific investment risks, and minimizing costs and taxes. The chapter draws parallels between the author's investment principles and those of Benjamin Franklin, stressing the value of saving, understanding costs, taking calculated risks, and the necessity of being patient and consistent. Concluding with a comparison to dieting, the chapter reiterates the simplicity yet difficulty of adhering to basic investment principles, underscoring the time-tested reliability of index funds in achieving financial success.